Bootcamp day 1. So these are the topics that we will be answering today, which is what Fabio went through on the bootcamp. So what moves the market? What is the nature of the market? How to know in pre-market how the day might play out, and how to map the market throughout the day. Okay, let's go. So first question, what moves the market? These three moves the market. So we have order flow pressure, fundamental reason, and option pressure. So based on these three, we know that the big players are moving the market. And how can we see what they're doing? Simple, through the immediate order flow print, which is big trade. And this is it. These are the big trades. So in short, they are not hunting your stop loss. Retailers are like 3 to 6% of the whole market, while the big players are 95% of the market. So nobody's hunting your stop loss. Yeah, that's it. Okay, next topic. What is the nature of the market? AMT. If you don't know what AMT is, I've done a video about it before. Here it is. You can watch it on my YouTube channel, and there I go more in depth into it. But in short, AMT is that market is an auction. Either we are balanced or we are imbalanced. That's when we move out of fair value. But go check out that video to learn more about it. If you already know, then just keep watching. So when we transition from a balanced into an imbalanced market, usually it's because of news or order flow pressure. So if the pressure from the big players is long, then eventually we will break out from the balanced area and enter an imbalanced market. But these two are usually the reasons. We all know that in a balanced area, we have something called points control. Now, when price is in a balanced area and it's chopping up and down, so we are ranging, that point of control will act like a magnet. So when we reach the lows, we'll then gravitate to the middle, vice versa at the top, if we are balanced. However, say that price now goes into an imbalanced market and finds balance up here instead. When we leave this balanced area, this point of control that previously was a magnet will now become a rejector. So previously the POC was a magnet and now it's become a rejector. Why? Because all of these aggressive participators that push the price above the value area will now defend this previous POC zone. So if price then comes back, you can expect it to reject from here and continue up. And this is a swing model that Fabio actually uses. So in short, all those previous aggressive players that push the price up will now defend the previous POC. Okay, next thing. What's the difference between a high volume node and a low volume node, and how do they work? So in short, a high volume node is where there was high volume on that level. So it was efficient distribution, meaning the market had time to take a lot of trades there and it was distributed efficient. A low volume node, however, is where there was low volume and where market didn't have time to distribute efficiently. So for example, this is a high and this is a low volume node. Essentially what this means is this: price had time to take a lot of trade and it chopped, and here it exploded right through and came back here and chopped. So we didn't have much time here. The market didn't have time to take a lot of trades here, so it didn't distribute so efficiently. And then we leave behind a low volume node. Whilst in the area that we spent a lot of time, market had time to take a lot of trades and we distributed efficiently, and therefore there are high volume nodes. So what's the point with this? These low volume nodes usually gets rebalanced because market comes up and has to finish the job before it maybe continues. That's the first thing. The second thing is a high volume node is a high protection zone. So what I'm trying to say is price usually stops in them, whilst in a low volume node, it's a low protection zone, meaning price usually goes fast through them. So see it like this: we are chopping, ranging, then when we break below, we move fast through them. And where we will stop? Well, most likely on a high volume node, we will chop again. So that's the key difference. Okay, now on to the next thing: how to know in pre-market how the day might play out. So the thing you can do to build a scenario for today is to use data from London session and previous day's profile. For example, if this was previous day profile and we are here, for example, now, use a volume profile and plot out London's profile. And with this, you then have your pre-market profile here. You also have previous day profile, Why previous days profile is important? Well, it's important because if we traded around here yesterday and today we open up here, that means we have shifted in value, which means the auction is long, pressure is long. So you most likely want to be bullish for today. But in regards to the pre-market profile, which is this one, they look differently every day. They can look like this. I made a video about it before. You can watch this video where I go more in depth into how you can trade them and what they mean. But in short, first one is a balanced one, meaning you want to fade the lows, fade the highs, and then basically play the range. And the lows and highs is value area high, value area low. Then we have the P-shaped one where the pressure is up, meaning on market open, we can anticipate that breakout and continue because the pressure is long, and vice versa for the B-shaped one. So the pressure is to go short. Now, Fabio did go a little more into a balanced one because he was showing the example on this type of day. So for pre-market, he also marked out the delta levels on the left side. And these levels are usually known as last line of defense, which means that if we come up to these levels, you can look for an amazing short back to the point of control, or say that we move down and accept price below this last line of defense. And then you see aggressive sellers entering the market. So what you can expect then is a trend following day. Basically, we will squeeze down, we will go lower. And one more thing I want you to take from this is this. If we are in a balanced market, you want to use a balanced model. That's obvious. If we are in an imbalanced market, you want to use a trending model. So while price still is in this zone, you want to trade it with a balanced model. As soon as we break below the last line of defense with some aggressive participation here, you want to swap to a trending model. So market can either be balanced or imbalanced, and you trade it according to what we are in. That's it. And one more last thing. If we break below this last line of defense, if they were support before, they will now turn into resistance. For a summary of this, as long as we don't break the last line of defense, use a balanced trading model. When we accept above with aggression, you swap to a trending model. Last thing, how to map the market throughout the day. So we got two ways. First way is the easy way. So you can use a full day profile. So when the market trades, you just extend your profile throughout the whole day. Then you have the value area low, value area high. If we are here, we are in discount, you can wait till we accept price back into value, look for aggressive participation here, and aim to point of control. Just use the whole day's developing profile. Second way is like this. Say that the price is developing throughout the day, and you identify zones that are consolidations, for example. Then you can plot these profiles. You're plotting profiles on zones and swings instead of the whole day. Here, for example, you might plot the swing this low to this high, so this swing. You plot the profile, you get something like this. Then you know that everything below here is discount, and you also know that since we accepted price above this balance area, then you can also plot the point of control. And if you remember what we said before about the POC, we are in a balance area. The POC acts like a magnet. However, when we break out of it, it then becomes a rejector. So you then get a zone here. And this is something he showed us using the range chart and he used 80 on the range charts. So it was not a normal time frame chart on the 1 minute. And one more thing that he showed us, which is quite interesting, is he also, in this case, plotted the most aggressive level, the delta level from the buyers, for example, in this case, the sniper level that he calls it. Then you can wait for price to come down here, test it. And if you found aggressive buyers here, then you can take a trade, stop loss below, and aim higher. And this was everything that we got to learn from the first day on the bootcamp. See you on the next one.